All right, everybody. Good evening. I'm Andrés Velasco, the Dean of the School of Public Policy, and we are here today to get two things on the right. But one, we get to launch at the LSE. It's been launched repeatedly elsewhere. Luis Garicano's book with John Cochrane and Klaus, how do you pronounce?
Masuch.
Masuch, entitled Crisis Cycle, Challenges, Evolutions, and the Future of the Euro, which of course is, the topic could not be more important and the authors could not be more distinguished. And in addition to that, we thought that rather than simply rehashing what the book has to say, he would give us a talk in which we put a little more political emotion into the book, and in which we think about what the other challenges are today to the survival of the euro. And one such challenge, I suspect Luis is going to tell us, is the pensioners. Those of us who will be pensioners, in the near future may take this personally, I don't know. But clearly I know where you're heading. We macro people know that close attention between fiscal and monetary policy. And when fiscal policy goes off the rails, as it may be going off the rails in the US, in the Eurozone, who knows, the sanctity of the currency is never quite guaranteed. So that's the tension that Luis will be telling us about. As the cliche goes, the speaker needs no introduction, but I will introduce him anyway. The School of Public Policy is very lucky to have Luis Garicano as a professor of public policy in our school, in our department. In addition to that, Luis has been a professor in the management department at the LSE, 20 years ago or something like that. Luis was also a professor at the Booth School of the University of Chicago.
And in the economics department of the LSE.
In the economics department of the University of Chicago.
His
PhD is from the University of Chicago, which of course brings to mind the old saying, nobody's perfect. Yes, another guy here is from Chicago as well. Two people who are not perfect. And of course, we are very lucky to have him back in the LSE. In addition to this, Luis is also a man who dabbled in politics for a while. He was among the founders of the Partido Ciudadanos in Spain. I was also among the founder of the Partido Ciudadanos in Chile. We had a rise and then a fall. Ciudadanos in Spain had a rise and then a fall. Lesson is, if you're going to start a political party in your own country, don't call it Ciudadanos. It doesn't seem to be the thing that lasts, right? So, the School of Public Policy likes to have people who know about social science in a very rigorous way, but who also have something to say about the world at large. And Luis is that rare beast, which makes me particularly happy to be here tonight. The modus operandi is very simple. We will give Luis the floor. He will have the floor for what, 20 minutes or something like that? Then I will take the liberty of asking a few questions, and then we will open up to you back. So, Luis, without further ado, the floor is yours.
Thank you. That's great. Thanks for being here. It's great to present the book, and it's great to see you here. So indeed, I'm going to try to make the presentation as up to date as possible by referring to current events, and there are two current events that are very relevant to the topic at hand. One is a good one for the euro, which is the fact that the US is kind of about to lose or losing its reserve currency status. It's been a very rough year for the dollar, not just because it has gone down in value, as you see in this Bloomberg chart, but because there has been a breakdown in traditional correlations. Whenever things go down, when the world goes wrong, people fly to safety, fly to the dollar. They haven't been fleeing to the dollar lately. They have been fleeing away from the dollar at the same time as they dump those dollar assets. Now, so why is this a good thing for the euro? Well, this is the inverse of the euro value. The euro could be that currency that takes over that function. It hasn't been the case until now, and I think it needs some reforms to take that. But there is a second event that I want to point out to you, which is somebody here will be familiar with the graph, Richard. I put the forthcoming because I didn't know what paper. Richard sent me this graph a couple of days ago. So the gathering underestimated demographic storm. So I have two graphs here. One is from a recent paper I put out with Ben Holmstrom and Nicolas Petit from the Institute of European University Florence, where I aggregated, the resolution is not great, I apologize. I aggregated the national pension and the implicit pension debt. The implicit pension debt is usually not aggregated as part of obligations of a country, but I think we are learning lately that the implicit pension debt is as hard to repudiate as the actual explicit debt. And so you see that different countries, Spain, France, etc., in this 2021 graph have 350, 400% of
that is the present value of
the
expected pension commitment.
Exactly. So this is 3 or 4 times GDP. If debt is another time GDP, we are at 5 times, 4 or 5 times GDP, probably now over 5 times GDP for many countries. The Eurostat has stopped doing this exercise, I guess. I guess we can all guess why. And then there's this graph that Richard Davis passed me that I was referring to at the start, which I think makes two interesting points. One is, and I think you guys all are familiar with the first one, which is that the fertility crisis, the fertility is plummeting worldwide, really plummeting everywhere, and that's kind of putting all pension systems at risk, obviously, and many other things. But second, and very importantly, this graph shows very clearly how all the projections have been wrong. How Richard shows here that, I mean, it basically all the time they think, oh yeah, it goes down, but it's going to continue up. It's going down, it's going to continue up. The actual is way worse than even the projection just a couple of years ago. And the new projection is probably, you could imagine that the projection doesn't just suddenly rebound. I mean, there are reasons to believe that it won't suddenly rebound. This is true for the Euro area states, but it's true for China, for the United States, for Colombia, for Tunis, for Turkey, for South Korea, for Spain. I mean, this is a general thing. So we have a gathering crisis. We have particularly tricky pension systems. How are these two things going to interact? What I'm going to do is I'm going to use the book, and I'm going to argue that the inability to enforce the budget constraints is incompatible with stable monetary union. So this is a problem for the US. Andrés probably will ask me like, oh, is this not a problem everywhere? And I'll say, yes, it is a problem everywhere, but you guys might ask. It is a problem everywhere, but it's a bigger problem where you can just pass the parcel, right? If we have a big credit card bill to pay, if I am the one person, I have to face the music. If we are like 5 or 6, I can hope that some of you will pick up the bill. So that's what makes it trickier in this particular case. So I will explain that. So I'm going to go back to the book. I'm going to explain you why I think the euro is poorly equipped to deal with that. And then I'm going to go back to the pensions problems. So the book basically has several steps. It goes through the funding architecture of the euro, the crisis, and the reform package. I'm going to just very quickly go through the funding architecture of the euro. I think most people here know that it was a monetary union with a fiscal union. We don't have a common debt. The primary objective is price stability. It's been funded very clearly in mind with the idea of we're going to avoid any monetary financing. We're going to put debt and deficit limits on the member states. We're not going to allow anybody to bail out anybody else. Now, what if all these things don't hold? What if all these nice promises that we are not going to ever, we have this common credit card that we all use together, I'm not going to ever go partying and you're never going to be in the red and so on. What happens if these obligations are not fulfilled? Well, the treaties say nothing about that. There is no idea of if a country just goes crazy, how would it go bankrupt? There's no sovereign bankruptcy procedure. How would we insulate the banks from default? There is no way to insulate them. In fact, the debt of every member state is counted as risk-free debt, so they don't have any need to take into account the sovereign risk weights. There is no crisis resolution body, no European IMF, and there is no common banking regulation, and no supervision, no deposit insurance. So there is first a voluntarism that says that, okay, we're going to avoid these problems by just not having them. I do want to say, like, if you think about a monetary union, there are some peculiarities here that I do want to emphasize. The first one is we have national central banks. Okay, the Spanish central bank didn't fire anybody when we went to the monetary union. You won't be surprised. The bankers have very safe jobs. The Belgian central bank or the French central bank, all the other central banks are still there. So the national central banks have functions such as buying the debt. They have non-monetary policy tasks. If some bank from Spain gets in trouble, it's the Bank of Spain who gives the loan. It's called Emergency Liquidity Assistance, ELA. And the bond purchase programs, when the banks buy the debt of a particular country, those are national. It is the Spanish National Bank. So when I will tell you later that Mélenchon is saying that the French central bank, the European central bank should cancel the national debt that they have in their books. In fact, it is the National Central Bank of France which has the European debt in their books. So that's special and that's interesting. So there are some programs which are Europe-wide, and there are some programs which go to try to rescue a member state, but I won't spend time explaining you that. We have a lot to cover. So in the first decade, everything was according to the plan, everything according to the initial philosophy. They didn't buy sovereign debts. They didn't intervene on the banks. Everything was kind of rosy and fine. Eventually, we had 4 once-in-a-century crises. Each crisis was supposed to be the one time we have a crisis. We had 4 of them in a very short time, and that eroded the institutional limits. And I'm going to walk you through that. The first thing actually happened during the good decade. The European Commission tried to sanction Germany and France for having big deficits. That would have been a very good thing, because if you start by sanctioning the tough kid in the class, then all the other kids realize that, hey, this is for real. France and Germany just said, no, we're not going to get sanctioned. They voted down the idea that sanctions could be imposed. The second thing that happened during that decade is that as the crisis started, the ECB started to support fiscally troubled countries and banks. The way they did it was through something which was called the Sarkozy trade. The Sarkozy trade was, we're not going to save the member states because that's not allowed. At the time, they thought it was not allowed. Eventually became considered allowed. We're going to give money to the banks so that the banks buy the debt from the states. So that was an operation to allow the banks to rescue the member states. The European Central Bank extended loans at favorable levels to the banks, and the banks they were nudged to buy debt of their member state. Now, you can imagine that's a great idea if you know the member states are going to survive. But if the member state goes in trouble, it carries the banks down with them, which is exactly what happened. Then there was also no debt restructuring of debt. Greece started to be in trouble. Greece discovered that it had much more debt in their balance sheet than they had, much larger budget deficit than they had declared. They were actually cheating on their. You went there to Greece at the time, I think, to help them out. So they, instead of saying, okay, we're going to just go bankrupt and we don't pay, the Europeans forced Greece to save the German and the French banks. It was the German and the French banks who had extended most of this credit. The Greeks were forced to bail. So it was the Greek citizens who paid for the Greek banks. You can imagine the Greek citizens weren't very happy for the German banks. So that was bad. But then in 2012, everything went catastrophical. It was really a disaster. And we were kind of towards the explosion of the euro. In fact, Greece was voted out of the euro by the Eurogroup, by the ministers. And at that point, Angela Merkel said, no, we're not going to let Greece be expelled. This is important for Europe. We're going to let the euro stay in place. So what happens is that there was a restructuring of the Greek debt, which is a good thing. That's why it's in blue. There was a 50% haircut. So we are going to just not pay half of it. And because Greece was also the lenders, not just the creditors have a problem not just the debtors have a problem when too much debt was extended. They started to do certain reforms. They introduced a single supervisory mechanism. They introduce a set of better fiscal rules. So this is for the banks. They introduce a recovery and reconstruction directive to wind down banks. You remember, Mario Draghi said in London, whatever it takes. He said the European Central Bank will do whatever it takes to rescue the euro. What happened was that after Draghi said this, the crisis started to subside. But in fact, this was not a crazy program like the bank will buy debt. This was a program that said, we are going to make this conditional. The member states whose debt we're going to buy, think of an IMF program. If you know an IMF program, same story. We're going to buy your debt, but you're going to have to go through a rescue package. And Draghi says, look, the conditionality is important because without conditionality, we're just supporting a member state and we're just issuing money to pay their debts, and that's a problem. So that was a good thing. And there was Cyprus, a big also bankruptcy. That was a good thing. So at the time, basically the euro was continuing to maintain the separation between monetary and fiscal policy. It was building good institutions, banking union, etc., etc. Now, we came out of this crisis with some momentum, but we lost it, okay? So the large countries didn't lower their debts, and they continued in the good times to have very large deficits. The progress on banking union stopped. Why is deposit insurance important? Deposit insurance is important because if each country has to save their own depositors, then when a bank fails, it carries with it the government of that country. Okay, Santander is now worth much more than the GDP of Spain. If Spain has to bail out Santander and the depositors in Santander, and nobody helps, Spain is bankrupt if Santander fails. So you need a European deposit insurance at the same time as a monetary union. This was blocked. It didn't happen.
The Irish one, right?
In Ireland, that's how both Ireland and Spain's crisis had to do not with a budget deficit that exploded, like in Greece and Portugal. Both have to do, these were countries with very low debt. Spain had only 35% debt to GDP ratio. And when the banks started to fail and Spain started to bail out the banks, and at the same time the revenue started to drop, then the whole country went bankrupt. That's what's happening to China right now with the real estate bubble in another episode of something that does tend to happen quite often, this link between the banks and the state. The ECB provided loans to banks, but they even provided subsidized loans. So the TLTROs, Draghi recognized himself that these were loans to banks. They were trying to get the banks to lend more, and they allowed the banks to borrow the money at below market rates, lending at market rates, at subsidized market rates. So in fact, the banks just have some money back, even if they just borrow money and deposit it back in the bank. So this was kind of iffy. A lot of these things are justified on low inflation. We're going to do QE. We're going to do low inflation. But all of this climbed one level when the pandemic came. The pandemic was a big problem. The governments were in trouble. The European Central Bank said, okay, don't worry. We're just going to lend you all the money. This is not allowed. The way they did it is we are not lending money to the governments. We are facilitating the transmission of monetary policy in the euro area. This was very iffy, okay? This was really an excuse that it's not quite what was happening. But I'm happy to discuss what they mean by the transmission of monetary policy. So then the ECB, and this is the day I decided to write a book, they came up with a transmission protection instrument. The transmission protection instrument is a tool that allows the ECB to buy any debt from any country as long as they declare that the country's trouble is due to malfunctioning of the market. So it says that if there is a deterioration on financing conditions that is not warranted by country-specific fundamentals, the TPI could intervene, and the scale is unlimited. Because purchases are not restricted. This is the bazooka, okay? The ECB says, we have a bazooka. If you go against any of our countries, we just shoot you. Now, that sounds good, okay? That sounds good. It's the ECB But the problem is, does anyone in this room or anyone in any room, any economist know what the hell not warranted by country-specific fundamentals mean? Nobody knows, okay? Would you say that the AI, artificial intelligence prices today are warranted by fundamentals? Half of the people here would say yes, half of the people would say no. Most people maybe would say no. The truth of the matter is the market believes yes. So market fundamentals is kind of a tricky thing to observe. And then
Where did that passage come from?
this was literally everything that exists. Everything that exists is the press release. The transmission protection instrument doesn't exist as a law. It doesn't exist as a program. It exists as a press release. We have decided to use this bazooka, and we believe it's in our mandate because it's non-warranted conditions that limit the transmission of monetary policy. This was basically, let me tell you a story of this. Christine Lagarde, COVID comes, Christine Lagarde says, we're not here to close the spreads. Then all hell broke loose. She decided, yeah, we are here to close the spreads. She introduced that program, the PPP. Now she needs to start taking out the PPP. And when she starts kind of trying to sell government debt, then there is panic in the market, Italian market, etc. People are like, oh my goodness, the ECB is going to get out. The big bazooka is going to be out. So then they say, okay, we are going to stay here. If you kind of react badly against any country, we will come in and shoot hard. Okay, that's why this program exists. So there is only one blue thing in that third column, which I happily participated in as a member of the European Parliament, which is we did introduce a measure of fiscal union, the Next Generation EU and the Recovery and Reconstruction Fund. But the truth of the matter is we had some bad stuff happening in the first crisis, a real kind of big set of institutional reforms that made Europe kind of closer to the ideal that it could be. And then with the two crises, basically the ECB said, we can do whatever we want. We can do whatever we want. You could say it's a fine thing. It could be a fine thing. The problem is there's a lot of people watching you, particularly politicians. And once they think, oh, you're there, you're going to do whatever we want, okay, that's fine. Okay, why should we be disciplined? Why should we be careful? That's the fiscal dominance that we're going to talk about in a second. So the consequences are a very large balance sheet. This is all the debt that the ECB bought. This is what it is still holding from the member states. This is in the asset side. This is all the sovereign debt that is in their balance sheet. Look how large it is. This is like 5 trillion, 4 something trillion. It's still very, very hard to unload. It's not quite Japan. It's the blue line, not the red line. The red line is Japan. Second, there is no interbank market because the ECB does all the lending. The ECB loans at non-market rates, and it allows banks from the crisis, the states from the crisis, it allows the banks to post non-marketable assets as collateral. And as a result, this means that the banks prefer, you can just put any asset there and get lending in exchange from the ECB. So you prefer to go to the ECB, which means that there is no market price in the interbank market. It's just money that the ECB gives.
They're not marketable. What assets are they?
So, for example, if I put in the ECB a portfolio of loans, of bonds from Telefonica, this is traded in the market, there has a price, the ECB knows how much it's worth. If I give them a portfolio of mortgage loans from Spain, how much is that worth? Depends on how much the mortgage payers are going to. Okay, so those are non-marketable assets. Assets that don't have a price in the market. Third, bank sovereign loop is alive and well. Here I show you how much is bank credit to domestic sovereign, how much is public debt. And as you see, the countries with a lot of public debt have a lot of credit from the banks to the sovereign. So the banks in Spain, in Portugal, in Greece are still lending a lot to the sovereign. If the sovereign had trouble, it would wipe out the entire of the bank capital. So that's a problem. Third, the incentives of the governments are bad. I will not spend a lot of time in here because I want to talk about the pensions, but the government debt, it's pretty good. Look at the euro area, it's not too bad. It's really the big countries, in particular France and Italy and Spain, which have been less, but particularly France, which have been less eager to reduce the debt. If you look at France, they have not fulfilled the fiscal rules any year except for one. France is the violet color. It either is out of the rules here or it's out of the rules here. So the deficit has to be below 3%. France has never been below 3% deficit, it's always higher. And it's basically ignoring that we have some fiscal rules since the euro was formed. This is what's happening with the fiscal position of France and Italy, particularly France, as you know. There is no growth reforms. I put a slide from my paper with Homson that basically Europe has been converging until 1980. It has been moving away from the frontier, from the US. 100 would be US, and we were closer to US and going away. Here is Eurozone output per head, GDP per capita, as a percent of the US.
Oh, it's not productivity, it's output.
It's output. And yeah, I put.
What do you call it, commercial frontier?
I mean, officially, I call convergence this rapidly, and I added its title. What I mean is, Europe had 30 years where we have a huge amount of technological progress, and basically we're growing much faster than the US. It's not just because of the war. Even before the war, we had many workers in farms. We had Europe had it was really backward with respect to the US. 0.3. The set of countries here is constant. I'm not changing the set of countries, and we converge until 0.8. We are advancing towards the US levels of output per capita, and then we are basically withdrawing, going back. I think the technological interpretation requires much more work. So, okay. So, and then the target, which I'm not going to show you. Okay. The last thing I want to say is the countries, and more specifically, the most specialist Italy, don't want to do reforms. You have behind somebody with a big bazooka who says they're going to bail you out of any trouble. Why would you want to have the European stability mechanism, which is a system that is conditional, that is going to put a lot of rules, that is not going to allow you to do what it wants? So Italy, first of all, has blocked deposit insurance. A country that would more likely to need deposit insurance is blocking deposit insurance. It has blocked the ESM treaty, which means that the ESM, which is the European FMI, IMF, the ESM doesn't have a backstop to save a country. Where would the Italians don't want the European IMF to have the ability to save a country? Because they don't want to be saved. If they're in trouble, they want monetary financing. They don't want somebody that you have to negotiate a program with, etc. So Europe, the French have blocked, the Italians have blocked this ratification. Now let me tell you about pensions a bit. So we go back to the plot I showed you at the start. So demographics is a problem. We're going from four workers per retiree towards 2 workers in places like Spain, France, Greece, the people that are moving very strongly. They're aging very rapidly. And that's giving us the deficits are driving the ECB into a corner. Because if we have the strict inflation targeting, then we're going to have eventually real trouble in some of these countries. If you don't inflate the debt, these countries are going to have big deficits, are going to have to borrow in the markets. If you do monetary financing, you're going to abandon the stability in the euro. So I want to show you the pensions in Spain and in France to tell you how tricky they are. This is from the FT, but I have seen this data myself as well. It's from John Murdoch. If you know him, he's very reliable. The French pensioners have a higher income than the French workers. Okay? Now, the Spanish pensioners had a much lower income than the Spanish workers. And look what happened with the crisis. The no default in the crisis means the people who pay the bills are the young people. This is the only people who are left. You raise taxes, you cut social, that's what happens de facto. These are the Spanish workers. This is the income per capita. This is a wage collapse. They get a little bit better off. They are at the same level today as they were in 2008. In the meantime, the GDP has grown. Yeah, it has grown a little bit. Who's getting all the increase in the GDP? The Spanish pensioners. Those are the only people who are better off. Look at the big increase. I mean, it's pretty significant. It's there to there. Okay, so these are in my view, it's the bad incentives that the Central European Central Bank is giving us. If you are French, you don't see, you're a French parliamentarian, you're a French citizen, you don't see the interest rates go up. You don't see, you're doing a pension reform. You're talking about killing the pension reform. Nobody cares in the markets, nothing happens. Then you get rid of the pension reform. Look at what Spain did. This is the official estimate from the European Commission based on estimates from the Spanish government of what the counter reform that the Spanish socialist government did of the pension system. It increased the structural budget deficit to 6.5 points. It increases it already in 1.9 already, 1.3 additional, 1 additional by 2040. By now already, by the end, by next decade, 3.3 points and 4, 5, and 6 in total. So we had a pension reform that we did during the Euro crisis. We killed that pension reform. So let me just tell you 3 political cases. France, in November, they killed the Born Law, which was the postponement of the retirement from 62 to 64. I mean, it should have been easy for the French because nobody has 62 in the world, so it's logical. Now, again, they don't see any consequences. So, of course, they just kill this. There is an impact on the deficit. There is a little bit of a reaction. It's very small. I mean, it's really very small. Can I prove that it's because the ECB is holding the rates down? No. Does it make sense that the market doesn't care, that France doesn't care about their pensions? I mean, I don't know. I'm a bit surprised. Let's see how the populists read all this. Okay, this is Mélenchon, his presidential program, and this is Bardella. Mélenchon says, we need to put an end to the shackles represented by austerity in European monetary policy. Abolish the 10% deficit, the 60% debt, which they have never fulfilled anyway, the French, and allow the ECB to monetarily finance the member states and to finance sustainable activity only. Cancel the COVID debt, so everything that went to ECB balance sheet needs to be cancelled, to make massive investment in environmental and social orientation. What does Bardella say on the other side? He says, we won't be able to avoid a discussion with the European Central Bank. He wants to raise the idea that the ECB could do quantitative easing as it did 12, 15 years ago. He says such a scheme accompanied by a credible 5-year growth plan could be in the common interest if he helped bring it stability. If the French economy cracks, the whole Eurozone will crack. Okay, he understood. Okay? He needs to just, like Samson, threaten to bring down the temple with him, he'll be rescued. This is Germany. Germany today has a big discussion inside the CDU. There is a plan to borrow to maintain the replacement rate and to increase the contributions. And it's basically a financial, they've put it together with some financial engineering where they are going to borrow to invest in the equity market. I don't think that's a great idea, but anyway, the young CDU people, the younger union, are refusing to support that. They've actually been pretty brave, and they talked in front of Merz a couple of weeks ago, their leader, and said, we are not going to put up with this, which is, I mean, unusual. Because in France and Spain, all the young people go to the streets to say, high pensions is great. I don't know if they've seen their paychecks, but... so there's a trilemma for Europe, which is you cannot have at the same time. I just asked Nano Banana today to draw me this today, and it looks very pretty. I just gave him my slide, and I gave him this slide, and it turned into this. So you cannot have the current system, public pension system, as generous as it is, the low inflation currency, and the nobody bails anybody out. Some of these things are going to have to fail. The way we are doing it now, I think, is we're going to sacrifice monetary stability and get the pensions funded by the ECB backstop like the TPA. So what is the proposal for a million-time reform package that we make in the book to try to avoid these things? We think that we believe that, okay, fiscal union is not going to come, so let's be realistic. Can we do monetary union without fiscal union? We believe that it can, as long as you have a sovereign bankruptcy procedure and you are credible in countries being able to restructure that debt. We believe that we need a European fiscal institution, which is like the European IMF. It's like the ESM that I already told you about, but with many more tools and powers to be not quite like a treasury ministry, but just one step below. A banking union without the sovereign loop, and I can tell you about that in the discussion. An ECB balance sheet that only purchases European debt and comes out of bailing out member states, and no subsidization, no purchasing of bank debt or member states debt below market conditions. So that's the story. Thank you very much.
So this is a fascinating story. It's also a frightening story, I think. You know, I used to live in the United States. I came to Europe thinking that it was a safer place to be. Maybe it's time to reconsider. I don't know. Where we're going next? Australia, Canada.
If this is about the euro, you're in the UK, which I'm not sure that's any better.
Yeah, no, exactly. I was extending that.
Yeah.
So let me just play economist I like a couple of boring questions about economics because I understand the story. I'm scared by the story, but I just want to make sure that I understand the wrinkles. So you're making a number of claims, and let me stop and ask you about two of them. One is that essentially what the ECB has been doing is, created massive moral hazard, right? And I sort of believe that, but I can imagine counter arguments. One counter argument is that nobody manufactures a crisis just for the sake of getting a few more goodies in the short run, because yes, if a crisis is going to happen 25 years from now, then what do I care? But if you're sufficiently close to the edge, then it may be yourself who pays the cost. So given European political economy today, tell us a little bit more why that claim is credible, that the ECB's willingness to buy bonds, pretty much regardless of what the circumstances are, you're claiming that it's been internalized by European politicians who say, oh, the ECB is there to save us. We don't have to worry.
So I think I provide five examples in the presentation. So one is the pensions in France. I honestly don't think a country on its own, France on its own, with the franc dropping like a stone over the last 6 months while they were kind of fighting over undoing the reform.
Not the franc, you mean
the franc on its own.
Yeah.
So if France hadn't been on the euro.
Oh, I see what you mean. Okay.
France on its own, with the franc as its currency, I cannot imagine going over the shenanigans it has gone. I don't think that's credible. I mean, I think the sense of urgency, the interest rates would have spiked up, the Banque de France would have been kind of horrorized, and the bankers would have been horrorized, and everybody would have been horrorized, and they would have said, how are you going to undo the 64 years old? It would have been, in my opinion, for a country standing alone, to just undo the 64 years old would have been impossible. The postponement of the retirement age to 64. Second, Italy opposing deposit insurance and opposing the ESM reform. So the ESM is the bailout fund of Europe. It doesn't have enough money to bail out Italy. Right. It says
it's an IMF without money.
This is an IMF without money. We say, okay, it's going to have a backstop. It's going to be able to borrow from the European Central Bank. How does Italy, which is the only country that cannot be bailed by the ESM, the only country that's credibly in trouble that could be bailed by ESM, opposing that? Because they don't want to be bailed out. Because they think the ECB is great. They don't want some deal where they have to promise to cut this or to cut that. The ECB comes, it's a market disturbance that is kind of non-warranted by market conditions. We are great. The markets are crazy. Please rescue us. There is no alternative. They will say to the ECB, sorry, there's no alternative. If there was a fiscal instrument, the ECB would say, no. You go to the ESM and they will see. But there's no fiscal instrument. So I think that the fact that the Italians have been blocking deposit insurance, which again, the Italians should want deposit insurance. I think those three facts, to me, I mean, the week after TPI, of the Transmission Protection Instrument, I was in Parliament then. The ministers of the Eurogroup announced that they were abandoning the deposit insurance in Europe. There was a roadmap for deposit insurance. There was no longer demand from the southern states for deposit insurance. France, Italy, and Spain no longer are pressing for deposit insurance. Why? Because they don't need it anymore. So, in my opinion, the countries know, doing the homework. I mean, I think it's pretty clear that having the pensioners in front right now is suicide. You're not going to win an election in Spain, in France, in Germany, in Italy, anywhere, if you are not promising the pensioners that their priorities are the first priorities. Once you start from there, the politicians are going to do whatever it takes not to cut on the pensioners. And if they can postpone it, they will postpone. I don't think they're manufacturing crisis. They're just thinking 4 years ahead. Did the Spanish government do a reform that their own Ministry of Economics, once Escrivá was out of government, they gave the data to the European Commission, and the Commission was, I mean, everybody in Spain was surprised that they would give it. The government itself recognizes it makes the structural budget deficit worse in 6 points. I don't think they could have done that otherwise.
No, as I listen to you, and you made a point that I think is fascinating. What's the counterfactual? Imagine you didn't have monetary union and you had individual currencies. Then what would happen is that the individual currency would depreciate.
Yeah.
Right? And that causes people to freak out. I actually, sorry for the self-referential point, when the euro was adopted, a guy called Aaron Tornell is a professor at UCLA, and I wrote a paper making exactly this point. The conventional wisdom is that fixed rates give you fiscal discipline because you cannot devalue. I've always thought that's wrong. Fiscal discipline is really imposed by flexible rates.
Yeah. Because
if you have a floating currency and you really screw up on the fiscal, the currency depreciates.
Yeah.
If you have a fixed rate, you know that there may be a balance of payments crisis 5 years from now.
We'll see.
But in the short run, the taxi driver,
doesn't see anything.
I come from a region in the world that taxi drivers really rule, right? So if the currency is depreciating, the taxi driver is nervous. If you're losing reserves because you're intervening to keep the exchange rate where it is, then the taxi driver says, reserves, I don't really know.
Yeah, exactly. This is exactly, I mean, you were right, I think.
So my second question, which is going to be a nerdy question, if things are as bad as you claim they are, and I'm perfectly willing to believe you, then it is not clear to me that the market should be so relaxed for the following question. Monetary bailing out of a bad fiscal situation makes sense in the very short run. You're buying a bond, but ultimately a central bank is owned by the very entity you're bailing out, right? So let's get rid of the differences across countries in the EU for a minute. You're saying there's a fiscal situation across Europe that is unsustainable. Then you have an entity called the ECB, which is bailing you out. But in reality, the ECB belongs to the same institution that is in fact bankrupt, right? So if I'm a holder of European debt, I should be able to see through this veil, right? And say, if the ECB does not have full backing from the fiscal entity, whatever that is in Europe, then the ECB ultimately is no good as a bailout entity, right? So why are the markets not seeing through that?
So I think the 27 countries is crucial. So you do have countries which have fiscal discipline. All the small countries are behaving pretty well. They all are fulfilling the rules, etc. I think the second thing is the interest rates are maintained by TPI and all of that. A third thing is, what is the alternative asset? I'm not sure what would you leave the euro for. And the next thing is, so let's think of one particular country. So why is France not paying higher rates? When France is not likely to be able to fulfill their pension commitments, they could have Bardella of Mélenchon. If you have Mélenchon there, he's going to say, okay, here is my plan, ECB, do whatever you want. I mean, if you don't fund us, we're causing you a lot of trouble to the euro. So France, the European Central Bank action keeps French. I mean, now the central bank is not only not doing quantitative tightening, but it's buying French debt. And France, and they would say, well, then Europe should have some inflation premium or should have some sense that we are eventually going to be in trouble. and it should have higher rates. I think that we have all seen this, Andres, and we see it again with Buenos Aires, and you know about this much more than me, about from the insiders and theorists as well. As Solo said, things don't happen or happen very slowly until they happen, and they happen much rapidly. They happen much more slowly than you think, and then they happen much more rapidly. You imagine, like Liz Truss in the UK. So,
Is that a Solo quote?
so there was Amazon.
I always attribute that to Dornbusch, but maybe
It's Dornbusch.
But maybe Dornbusch got it from somebody else.
I think it might be
the MIT crowd.
I think it might be Dornbusch. Am I getting the next office, the neighbor? I think that this is kind of a bit surprising to me. I won't deny that the market is so sanguine with the French, for example, counter reform. But I do think that as long as the ECB keeps this going and it's able to buy the French debt necessary to keep the spreads low, then this doesn't start. I mean, I've talked to participants in the market. I've asked them about it. They say, well, just a question of liquidity. As long as, they have more than you have and they're going to just come against you, they can counter it. But if the member states think that's the problem, right? Once the member states think, oh, the ECB is almighty, then that's a problem.
I have two more questions, moving a little bit away from the monetary bit, and then I want to open it up to. So let's talk about pensions for a minute. Leave aside the euro. I completely buy your story that the debt dynamics in the pay-as-you-go system with this kind of demographics is simply not going to, is unsustainable, right? One country that seems to have gotten it right in Europe was Sweden, and Sweden moved to a system that is different. Sweden is a member of the EU, of course, but not the Eurozone. Is there anything in that experience or any other experience anywhere else that provides a guidebook, a playbook to what, the main countries in the Eurozone could?
You will be surprised and amused to know that we took, in Ciudadanos, I took the Swedish model as an example for the reform of Spanish pensions.
Okay.
It's called notional accounts.
Right, exactly.
And the idea is that you put your money and you get a statement for how much money have you put.
Right.
And you get a letter in the mail that says, here's how much you have put. And then there's an interest rate applied to your money. So you know exactly how much you contribute.
Right.
We don't have any mistakes
So
with
it's a
pensioners.
Chile system, but in Swedish.
Chile has
Without
that's
really having
private.
funds.
Yeah, exactly.
Exactly. Without really
His
having
money
funds.
doesn't exist. It's still a public system. It's just that you keep track of it.
Right.
It just makes it transparent. In principle, it shouldn't make a difference, but it makes a difference, right? In Spain, the net present value.
But there's something else the Swedes did. You do every 2 years or at the end of each year some actuarial assessment of the viability of the system, and if the accountants say it's not viable, then you adjust current pensions, right? Which, can you do that without being Nordic?
That's the problem, right? I mean, we definitely didn't win the elections, so we don't know if it would have been possible. My view at the time, and I told Escrivá this when he did the counter reform of the pensions, was that there's a political window to do these things, which is when the pensioners are a lot, but not everybody. As the people who are receiving a pension grows, your ability to do things that could be painful for them is sharply reduced, right? So I think the time for these things, France has shown that it's passing. It starts to be passed. The alternative, which is what Spain is doing now, we have a clause that says if the pensions are too high, it's obligatory to raise the pension contributions. Young people pay.
I have one more question about the reserve asset, but on the political economy of pensions, you said in passing, as a throwaway remark, something that I think is true, which I don't understand, but maybe you do. Why is it that pretty much everywhere, when pensions are about to be cut, reformed, restructured, it is not, the 80-year-olds don't march, it's the 25-year-olds who march, when it's completely and totally against their pecuniary interest? What is the intergenerational solidarity?
I don't think it's solidarity.
What is going on? I
don't think it's solidarity. I think they believe that this pension is going to be maintained, and that if you just complain enough, it's going to sustain itself after 40 years. And in France, they tell them that this is just a question of making a few wealthy people pay more. The problem is that if you do the sums, first of all, the wealthy people are very movable. Okay, if I can move countries, come back from Madrid to London, and you from Chile, A person who has 100,000, a million times what I have, for sure is going to be movable. Second, I don't know, I hate false consciousness. I hate to think that people are confused, but there is a lot of people who aim to confuse them. In Germany, as I was telling you, is the first time I saw the younger union of the CDU complain and say, we're not going to pay anymore. You're not going to raise the contributions. But the way this is being financed right now is increasing contributions from the employers, the employer contribution, and employer contributions are kind of invisible. People just see that their wage doesn't go up. In Spain, you saw it. What people are getting doesn't go up. Because if you earn 1,500, it costs 2,800 or 3,000 to employ you. You don't see all those gaps. You just see the income tax, which is a little gap, and the part of the contribution, which is yours. You don't see all the other contributions that the employers are making. And it's kind of, I think if we just did that reform, which is everybody gets the entire check and then they have to contribute that, they would start to see it.
One veil is real versus nominal.
Yeah.
Another veil, something that 99% of people who are not economists don't get is, the logic of tax incidence, right? I mean, my skinny country of Chile has just done a reform in which we added 6 points to employer contributions, and everybody's saying, oh,
they are going to pay.
They're going to pay, exactly.
I tried
the
to.
labor market adjust. It's completely alien to the logic of 99% of human beings.
I tried to explain this in TV many times, of course failed. Let me do it and you'll see why I failed. Yeah. I said, look, the only thing the employer cares is the entire wage bill. All the costs up to how much they pay. The only thing the employee pays is what they get home. How you divide that wage doesn't matter. I never succeeded in explaining that.
No, I tried once. I think fascist pig is what I was told I was. So, one last question, and then I've talked too much. The future of the euro. You began by showing us a picture which suggested that the dollar is not as mighty as it used to be, which raises the question: where do we put our money? Some people, think it's going to be the RMB. I don't think it's going to be the RMB in the next 25 years because you don't put your money in a country with no independent courts, right? Lula thinks that the BRICS are going to come together and come up with a currency. That's complete and total fantasy, right? It's not going to happen. The Canadian dollar and the Australian dollar are perfectly nice currencies to have, but they're tiny. So the only candidate for an alternative safe asset to the US dollar is the euro, right? Yeah. So it seems to me naively, and let's put the fiscal issue aside for a minute, that this is the moment when the euro should be flexing its muscles, right? Yeah. And you know better than I that 27 different proposals there are out there to create the liquid market in European debt that is needed. Just for non-nerds in the room, if you're going to be holding a lot of one currency as your safe asset, you don't want to hold the currency. You don't put the bills under your mattress, right? You hold bonds denominated in that currency. So you need those bonds to be liquid and to be plentiful. Today you don't have that because you have German debt and French debt and Italian debt, and the euro debt is what, 750 billion, which is
a little bit more, just $1 trillion. Yeah,
I feel $1 trillion, so it's not very much. So you could swap it, you could paint it green, you could do lots of financial engineering. Have a big treasury market like the treasury market in the US, not as big, but sizable. And then the world would want to hold euros, and Europe would flex its muscles, and they wouldn't have to go to the Oval Office and genuflect as they did a few months ago. Why is Europe so extraordinarily reluctant to do that? I was in Brussels last week presenting the other book, and I asked people at Bruegel, including lots of Germans, why can't you do this? And they all said, oh, no, that would mean mutualization of debts. And then, again, we're letting Italians off the hook. I don't get that. Can you explain it to us?
So for the first half of your statement, let me say something I heard in the city recently. Dollar, you hate the currency, love the assets. The euro, you love the currency, hate the assets.
That's a good one.
So we don't have the assets, as you said. You can buy German bonds, but I mean, the dollar is 30 something trillion treasuries, and the German bonds are single digits. Spanish is 1 trillion and whatever. I mean, all those countries are small by comparison with the dollar. I made one of those proposals with Marcus Brunemeyer and Ricardo Reis and others. The SB proposal, which was for a synthetic debt in 2011. We've kind of kicked it around often when the times come and people look at us and ask us. But they would never been successful indeed. There was a proposal, it got to Parliament and it was in the committee. It was never passed. I think it even passed Parliament at some point, but it never passed by the governments. The governments there is a mix. When you go to Italy and you present a proposal like mine, they say, no, we don't like that. The Italians, if they like the idea they're going to call their banks and be able to ask the banks to buy their own debt. They don't want a common debt unless there is a lot.
Don't want a common debt.
They don't want a common debt that is not issuing bonds. They want a common debt if it's euros issued by a European treasury and so on, but they don't want a synthetic instrument. They think they're better off now. As to real common debt, then the Germans don't want it, of course, because they think they're going to end up holding the can for all these pensions that I showed you. So it's going to be very hard to get a joint asset. I think monetary union without fiscal union is what we're going to get, as much as that is. I think you have Richard with a hand up for a while.
Floor is yours, sir.
I was writing what's down. This is absolutely terrifying and really interesting. Thank you. On your point on France, I think that must be correct. When you look at the French pensioners, I think, Luis, that the example you give might be a smaller shift actually than the Liz Truss blow up, right? You've seen it was a big blow up. It was actually a relatively small shift. And you've seen that since then, everything Rachel Reeves done, everything's just gone back up and down. So I think you can just compare the two, right?
Yeah.
So I think you're completely right on that. My question was, I think there's an interesting similarity. There's like an underlying thing as well as the euro thing over the top. And I wonder if you could talk about whether this underlying thing is also a problem outside of the EU. I'm not sure if this is on. I should talk about. Which was inflation targeting oversold? And what I mean by that was that we could just control the policy rate and the yield curve would flow and everything would be hunky-dory, following the papers of the 80s and then New Zealand doing it and so on and so forth. When quite quickly you got the Greenspan conundrum, the Fed was raising the policy rate, but actually the long end was coming down because Chinese were buying so much and that people were worried about that. Here in the UK, we had the GFC, we slashed the policy rate, the long end stayed at about 4% or something. So basically we kind of congratulated ourselves that we put in place this great inflation targeting, but actually control of the yield curve was a really important thing, which through these crises has messed up central banks. It's actually messed up the Bank of England and the Fed as well. And that's a kind of underlying thing, which this is then led over the top. There's two foundations here. It's a fundamental thing that actually modern central banking is not in a great way. And then you've got euro on top, or is this kind of uniquely European?
No, I think there is a general problem with QE and with the feeling that inflation was undershooting and that we needed to do all this crazy, enormous amount of quantitative easing for a quarter of a point or half a point of deviation of inflation. Now we are unable to undo this. The proof that this was not the right policy is that there is no freaking way to get rid of all these sovereign bonds. And I think that was a general view that has to do with the way Japan performed, and Japan is special and it has enormous savings rates, and it's been special. I think that also probably more disciplined in many ways, but the European twist is tricky, I think, and the reason the European twist is tricky is because you have individual governments who can kind of hide their responsibility. And that political economy, the collective action that Lloyd likes to tell our students about, the collective action makes all of this much more complicated. I think that's the two things are playing together to compound each other. That's my sense.
I have lots more questions, but I don't want to monopolize the floor. Yes, sir, back there.
So what we've seen is quantitative easing only growing since the first time it was really implemented. At which point is it no longer seen as credible by markets?
So it has been going down. As I showed you in the graph, all the part that has to do with the LTROs, with the long-term refinancing operations has been going down, the bank part. So there was loans to states, loans to banks, loans to states, buying bonds, but that's loans to states. In Europe, I smile because in Europe there's a very big difference between buying in the primary market, which would be lending to state, and buying the same debt in the secondary market, which is allowed. It really economically doesn't make a difference. So that second part, the buying, the quantitative easing, the buying the debt of the states, has been very, very tricky to withdraw indeed. At what point do inflation expectations become unanchored and people think like, okay, this is kind of really starting to look like monetary financing? I think it's going to have to do with the way this moral hazard evolves, with the way our government's going to really kind of example. Do we have a Mélenchon government or a Bardella government kind of try to find their luck, to push their luck in the two ways that they declared there? I think if it was Mélenchon, he would do it, right? I think if it was Mélenchon, he would just have a big program. He wouldn't come in with austerity. You can be sure of that. And he would try it. Could Bardella...
If he had the votes in the assembly, which he might not.
If you had the votes in the assembly. But Bardella would have the votes in the assembly. If Bardella wins, he will have the majority in both chambers. If he wins, what will he do? He could take a page from Meloni and think, well, let's be prudent and not go too far. Meloni stopped the big super bonus program that Italy had in place, which was big. It was a 25 billion budget program that ended up costing 225 billion. And Meloni stopped it. So it could be that Bardella thinks, no, we're going to be prudent. It could be that he thinks, if I'm prudent, I'm not going to be able to govern. I need this serious conversation with the ECB. I think that's going to be really the moment when we see if this moral hazard is kind of, winning, or if at the end of the day, some sort of discipline wins. I think that's a big, at least one big moment.
I hear you talk about Bardella or Mélenchon running France, and
You get shocked, yeah.
Yeah, I try to picture it and I can't, but that only shows my lack of imagination.
But Andrés, do you imagine again, would we have populists talking like this if there was a French franc in free fall? People would say like, no, we want to be prudent. We want serious fiscal management. We want prudent people. We don't want crazy people,
I am going to rediscover my 1994 paper.
Yeah.
I think I've always thought this is a real argument, right?
Yeah.
In the case of Europe, it's a bit more complicated because you have two things at once, right? You have a change in the exchange rate regime, and you also have the externalities of being in a union. So they're two things at once, but they both point in the same direction.
Yeah.
Yes, sir.
I just wanted to ask about Greece. I hope the question makes sense. Do you think that the case of Greece contributed to this moral hazard, or do you think we forgot about what happened in Greece already? Because, people were in lines to the bank. There was bank runs. It was very close of them going bankrupt.
They went. There was 50% that
they went bankrupt.
Yeah.
I remember the discussions in Germany were very harsh, and it was like it was a crisis. I remember for weeks, like the news programs were going crazy, and what happens. So it wasn't at that point, if I remember right, sure that the ECB would bail them out. It was essentially other countries, right? So did we forget about that case, or did it actually contribute to?
So it's very interesting because people read Greece in different ways. My view is that Greece was eventually handled well after we tried to do everything wrong. So I think that the haircut, 50% haircut on the debt, that at the end, the ones who lose are the ones who invested a lot on Greece and wrongly. They get punished. That's good. They had a very long list of structural reforms they did. Greece is growing. Greece has no budget deficit. It has a very serious government. It had already Tsipras with Syriza, the extreme left government was very well behaved and very careful. So I think Greece eventually was a lesson in we need to do things well. That's why I was emphasizing, and we emphasize in the book, the big states versus the small states. I think in Europe, the Commission is able to impose discipline on small member states and make them fulfill the budgetary rules, at least after the crisis. The problem is when you're facing France, one of the phrases that we opened the book with is a quote from Jean-Claude Juncker, who was asked in the French Senate. I think it was in the French Senate, but I might be wrong, but I know the question was, okay, why are you not imposing these sanctions on France? He was the president of the commission. And he said, literally, he answered, because it's France. He literally said, we don't impose sanctions on France because it's France. We don't do it. So I think that for the bigger member states, the commission is just not credible. And once you have that, you don't have market discipline for the reasons that we have said. You don't have commission discipline. I mean, you're France, the commission wants to yell at you. On the other hand, you have 10 million or 12 million pensioners yelling at you. Who are you going to listen to? I think you listen to your pensioners and tell the commission to go.
I mean, the point Luis is
help.
making is very important. I would underscore it and make it slightly differently. The narrative always has been that, the Southern European countries are the ones that have a good time and the Northern European countries pay the bill. In the case of Greece, the actual real adjustment was massive.
Yeah.
And I was involved helping the Greek government, so I know a little bit about this. Real pensions fell by 12%. Find me another country in Europe where the pensioners will take a 12% cut. It hasn't happened, right?
No.
The hospitals didn't have sheets and towels. I mean,
and real wages went down by
real
half.
wages went down by a third in some countries, not across the board. So, the Greeks really took the medicine.
Yeah.
The medicine came about 8 years too late. And so the whole
They suffer unnecessarily.
Yeah, exactly. The medicine could have been taken earlier and it would have been less bitter. But, they paid a price, right?
They did.
It's a price.
They did.
But it's, it's actually the rich countries that haven't wanted to pay that price.
Yeah.
So the political economy is a little bit different than the standard narrative suggests.
I have one question. Can we maybe talk about the role of Germany a little bit more? Because I think it's easy to think of them as kind of the bad guy. They've been very harsh on Ireland and other countries, but then they've also been culturally and historically very good at saving, and that arguably kind of helps with stabilizing the euro. And now they're like a strong voice against common debt. Like, what is really the fair thing to ask of them, and what role should they have?
That's a great question. What's fair to ask? I would say Germany's role has been overall a positive role. I think the initial role was, let me say that it's not so much about Germany. Okay, what you learn in this job of being an economist doing policy, and Andrés will tell us much more if he wants, is that the capture by the bankers is not because the bankers have you in their pocket. It's because no prime minister in trouble calls an economist for advice. They call the bankers. So the whole market's going to hell. I'm Merkel. I'm really desperate. Who do I call? Joseph Ackmann, the president of the Deutsche Bank. What does Deutsche Bank say? Like, don't bail us out? No, he says like, oh, if Greece goes under, that's the end of the world. You need to make sure the Greeks pay every single dollar, even if they are just desperate, etc. They need to pay. Okay, so I wouldn't blame Merkel at that time,
Sorry, and they call the bankers because the bankers are powerful or simply over?
I think because that's who they trust. The market's in trouble. Who knows about the market? I think that's what happens. I don't know. You tell me. I mean, you were a professional at a crisis, so you could have decided yourself. But this was the very first conversation I had with Klaus, my co-author here. Klaus Masuch is a very, very, I mean, wonderful civil servant, a German civil servant, a person who has been in the European Central Bank since the day it was created. And the first conversation I had with him was like, I am completely despondent. We just tell these things in Spain, the savings bankers are going to bring you under. You cannot rescue this, you cannot rescue that. I mean, and it's rescue left and right. And he said, well, this is just like what the bankers are telling the politicians. The politicians are never going to be trusting, you know, they don't want to trust that if you let some debt be restructured, it's going to be okay. They prefer to say, well, let somebody make the effort. So I would say Merkel followed on the footsteps of many politicians who thought bankruptcy would be the end of the universe. It turns out 3 years later, Greece defaulted. 50% of the debt were not paid. But it was after Greece had paid the first round, had issued more debt, had been in crisis for 3 years, the money had run out, and the only people left to pay were the Greeks. So that was bad policy making. As I told you, I'm willing to excuse it because of the way it all evolved after Lehman's, that there was this idea that if you let anything fall, the world comes to an end. But it's kind of unpardonable for the reasons Andrés was saying. The Greeks suffered much, much more than they needed to. Now, having said that, Merkel had one day, and I know it from one of the people who was in the room at this moment, she had a decision from the Eurogroup to let Greece fall out of the euro. And it was decided. It was voted. It was decided. She went back home. She talked to her husband. She didn't call any advisor. She didn't call anybody. She came back in the following morning and she said, we're not doing this. This is a political union. This is a symbol that we are committed to Europe. We're not letting anybody fall out of the euro. Now, you could say it would have been better for Greece. I don't know. I don't think so. But she was committed to Europe. She was committed to the euro. So it's hard to really make a kind of black and white color like most people want. I think now Merkel had another moment like this, which was the Recovery and Reconstruction Fund, right? The next gen in Europe. Italy was in trouble, Spain was in trouble. There was a risk that Spain and Italy would really fail because of this big COVID crisis. And Merkel said, we're going to issue Eurobonds, even though I've spent my entire life saying it's over my dead body. And there was a very large amount of debt that was issued, 750 billion indeed, that then has been rolled over and is now larger and so on. Together with quite a lot of other types of debt from Europe that we have. So she kind of rescued Spain and Italy, and you could say she rescued the euro at other times, but she also had a bad role with Greece and the way that the citizens and not the bankers paid the bill for that crisis. The bankruptcy was only after Deutsche Bank was out of the mess. Any crisis in Europe, you always know Deutsche Bank is involved, and they always kind of find a way to get out. I would say the Germans, there is another thing that I would ask the Germans, the deposit insurance. So Germany has a system of 1,000 Sparkassen. 95% of these are the savings bank. 95% have a politician in the board. The local politicians sit in the local Sparkassen and give loans to the local businessmen, the local building companies. And this is what led the US to a huge crisis with the savings and loans. This is what led Spain to a big crisis with the cajas. So this is not a good idea. But we said, okay, we don't include them in deposit insurance. We just do deposit insurance for the German banks. Even then, Germany was reluctant to do deposit insurance. They never wanted. I think deposit insurance is necessary in a monetary union. I think you have to get not the member state behind its bank, but the whole Eurozone behind the banks. And you have a European supervision. So Europe knows what it's rescuing. In my opinion, that's something that the Germans should have done.
given that bailouts to banks under supposed deposit insurance, I run on the bank, so you bail me out. If that is financed through real fiscal backing, that's not a problem. Isn't it likely that it would also be financed through monetary emission, and therefore it's a little bit like
I think
the
so.
things that you worry about?
I think that's exactly what would happen. I think that's why Italy doesn't want to have the ESM be able to help the SRB, the resolution mechanism, the single supervisory resolution mechanism, single resolution board, which are the things that would take over a banking crisis. They don't want them to have too much money, so that again, the ECB is behind.
The ECB, right. Good.
Yeah, so I'm so depressed. So I'm looking
It's really depressed.
So I want to see that little blue bar go up and up and up. And at the very end of the talk, you ended. It was like you waved a magic wand, which means I have to read the book because hopefully. And you said
I was
all these
I was
things are-
9 minutes out of time. My thing was.
Fair enough, but so a lot of this comes down to politics and to these very powerful pensioners, and they're not going away. And yet, at the end, you say, "Oh, so we need, we need basically a fiscal union. We'll start with deposit insurance. We won't allow countries."
I didn't ask for fiscal union because I don't think it's possible.
But so
I asked
my question
for-
is the things that you do think are possible. I mean, you flip through the slides. So why are those possible?
Okay, so the
Is there some
bankruptcy.
political? What's the?
So I
political
want a
logic for the-
sovereign bankruptcy procedure. And sovereign bankruptcy procedure means that each country faces their own credits. Creditors, they face the market. So you are Illinois or you are Kansas in the US. If Illinois or Kansas don't pay their debt, then they are on their own. The Fed doesn't come, the US government doesn't come, nobody comes. That means that Illinois negotiates with its pensioners. Okay, look, they always give too much money to the police, as you very well know, and the police always manages to get these deferred payments. But my friend told me the other day that his bill is going up by 50%. His bill for the real estate because there was a letter from the controller saying it was because the pension bills were going up, and the real estate in the downtown, people were exiting downtown. So Illinois and Chicago have to face their own pensioners on their own. In Spain, in Europe, it's still not clear because you're hoping, well, somehow this is common debt or whatever. I think a common bankruptcy procedure, a single bankruptcy procedure that is credible, that says we're not bailing out anybody. Here's what will happen. Would make the interest rates of the different countries move separately. Now they're all moving together. Of course, the transition to that, I do wave at one about that. So once you tell the market, well, France actually, you think that the ECB is behind it with a big bazooka, but it's not, then the market is going to get a bit of a fright. But I think that's the only way to get the French pensioners to.
But you see, in the States, you have 50 states. Some are big, California or New York, but they're not that big. Whereas in Europe, the size is so asymmetric. It's France and Italy and Germany in the middle, and Spain to some extent, and Poland, and the rest are, much smaller. So is it imaginable that if you had that sort of resolution of individual countries, the rest of the union would basically cross their arms like this and say, France, you deal with it?
I think that it would have to be credible if we are going to have a separation between monetary and fiscal union. Otherwise, we're going to have.
You're telling me that's a little bit like saying, if I want to be 2 meters tall, well, you're going to have to grow, but tell me how, right?
I don't see an alternative. This is to your growing. There is no alternative to. I mean, I don't think a fiscal union is going to happen. And I politically, anybody who's seen what is happening with the pensions in the south of Europe and the implicit pension debt.
I agree with you that it's not going to happen because the Germans and the Dutch and Finns are not going to go for it. But just as I am skeptical about the political feasibility of that outcome, I am also skeptical about the political feasibility of the other outcome. Imagine, okay, make it even more dramatic. Germany's debt to GDP ratio is not trivial, right? Imagine there's a spike in interest rates, whatever. Something really happens and the markets are running on Germany. Do you think the European Union is going to say, oh, Germany, just, you deal with it on your own. France, you deal with it on your own. I mean, these are too large. They're at the heart of Europe, right? Even Italy's too large. right? So is it imaginable that politically that happens and that there are no spillovers?
There will be spillovers. It doesn't have, I mean, no US state has gone bankrupt since like Kansas in 1850 or something.
With all due respect to
But-
Kansas, who cares about Kansas?
No.
Right?
No, but what I mean is you don't have to be bankrupt in order for the market to charge different rates for everybody and for this market discipline to exist. Look, the political discipline, which is the commission telling you, you cannot spend this money, it's not going to work. So it's going to have to be market discipline. And the market discipline only exists if the market believes there is a chance they will lose the money.
But last time we had different rates across different countries. That is actually what prompted the ECB to intervene to begin with, right? You know,
Yeah.
12, 13 years ago. So having seen that movie and having seen the outcome of that movie in 2011.
No, but I don't think there was different rates in different countries. I think there was real, like, I mean, Spain had 100 billion refinancing need. We could just not get the money. Literally, like we had to bail out the biggest bank, Caja in Spain. That in itself was going to cost 100 billion. We had a sudden stop, a full-on sudden stop.
The debt loop, I mean.
Yeah,
the
exactly,
of the
doom
bank,
loop,
right?
yeah.
I'm just on you today.
There was also a question in the back, yeah. No, but go ahead, Richard.
Yeah, yeah.
So,
This one works.
in the very early phase of the crisis, I was on a board thing called the EU Subcommittee on IMF Lending. So I had to go and represent the Bank of England. And I started doing that in about 2005 or something. And 2005, 2006, everyone around the table, you vote in order of country size, and it goes round and goes finance ministry, and then central bank, then finance ministry. So the finance ministry always goes last because it's more senior, except for the last desk to your question, which was Germany, where it's flipped. So the Bundesbank goes last. So the Bundesbank had the most power. Anyway, to the point, and the reason I think Luis is right, before this kind of big duvet or cloth went over everyone's going to be treated the same in 2007. We'd been talking for 2 years, and we're all going to say the same thing or something. Then Iceland and Ireland, if you remember, went first.
Sure.
Yeah.
And the European countries all had a different exposure to those. And the coordination broke immediately. And people were saying, so we as the UK had a big exposure to Iceland. So we were saying, well, let's definitely do something for Iceland. The Germans had no exposure. They were like, absolutely no way. So when people knew that the cost would be borne by their individual country, self-interest reigned before everything got smothered together.
Yeah. No,
Which
totally.
I think would come back if you did.
Totally. Yeah, you get the last question, I think.
Okay.
I think maybe he should get it since he was not asking yet. Okay, forget the two. Come on.
Okay.
Right, Andres?
You both go for it, but make it succinct, please.
Okay, so you suggested we're not going to move to fiscal union. So if we were to project 10 years, do we see fragmentation of the union?
I mean, if you take Andres' position that the two sides are completely impossible, then yes, I will answer both together.
Yeah, my question is, does one, I mean, I see the political capital one needs for this type of reform, and I don't see it in my friends. I have friends burning cars in France for pensions. My question is, does one need a crisis to wake people up? And was this the COVID was the crisis we needed? And the fact that there was so much fiscal expense to smooth it out, just keep people dormant on the problems there are?
So that's a great question. So this is the year of the wake-up calls, right? Europe has had 6 wake-up calls, like Trump, the SOFA scene, the trade and Thornberry deal, the SOFA scene, I meant Ukraine with Zelensky. And we're still sleeping, right? So all these wake-up calls are not sufficient. I mean, I don't know what bigger wake-up call do we need. So the idea that crisis needed is maybe correct, but the crisis that we're going to need is really so big that I don't know what will happen afterwards.
Naively, I would have expected that the wake-up call that would make people wake up is a guy called Putin in a country called Russia, right?
Yeah.
You know, because the markets, but missiles are a different question, right? We've seen drones over airports in Western Europe, not in Poland, in Western Europe.
And today is happening. And David
Yeah.
French today was saying in New York Times, we're going to see a war in Europe.
I would have thought that that would be the wake-up call, right?
Usually is.
I think,
It's usually the impetus.
Right, but,
Yeah.
but you know, how many drones do you need for the wake-up call to be really waking you up? I don't know.
I don't know. I mean, that's okay. And as to the other one, if there is no wake up call and we continue sleeping for 10 years, is there a risk of fragmentation? I sincerely hope not. I'm going to be keeping working. I think the euro is a good idea. And I think it's a very popular idea. People like it. People very much like it. And I like it. I think it's a good thing. But particularly once we have it. I mean, I don't know.
I mean, I would add as a non-European, the world needs Europe. There are too many bad guys out there. I mean, I look at it, the world from my corner of the planet, and I think, you know, the Americans used to be reliable, no more. You know, China's a superpower. I'm not sure I want to depend on them. You know, India is very nice, but not rich enough to really matter in this domain. So who are my friends? You know, the only friends that, you know, decent people can have in the world today are the Europeans. But Europe is so slow in making any decision that you think, do I really want to have these guys as friends, right?
Maybe we're too distant for our own good.
In any case, on that.
Thank you,
note,
Andres.
thanks, Luis.
Thank you. That's great. Thank you. Thanks very much.